Hello class, this is Dr. Fenton. In Chapter 7, we are going to discuss long-term assets. So let's get started. Now, long-term assets are broken down into two parts. There are tangible assets and intangible assets. Tangible assets are items such as land, land improvements, buildings, equipment, natural resources. These are items that have a physical substance. On the other hand, intangible assets will be things like patents, trademarks, copyrights, franchises, and goodwill. These lack a physical substance, and the existence is often based on a legal contract. In a balance sheet, you'll find long-term assets under the section Current Assets. So this can be called like property, plant, and equipment. Sometimes it's labeled long-term assets, but it goes below current assets. You'll show the property, plant, and equipment separately from the intangible assets. And then below that you can have items such as other long-term assets and investments. When you record anything in the property, plant, and equipment area, you'll record the item at its original cost of the asset, of course, whatever you pay for it. Plus you'll include, as part of the asset, all expenditures necessary to get the asset ready for use. Now, for example, land. When you purchase land, you will record in a separate land account in the balance sheet the cost of the land. What did you pay for it? How much did it cost you? Also, you will include in that land account any expenditures that you incur to get the land ready for its intended use. So in addition to the actual cost of the land itself, you'll add to that cost in the land account in the balance sheet real estate commissions and fees that you, the buyer, might pay for. If you have to pay the seller's back property taxes to be able to buy the land, maybe because the seller did not have the cash to do this before closing, then that will be included as part of the cost of the land you're purchasing. If you now take the land after you buy it and you clear it of debris or maybe shrubbery or whatever, and you bring dirt in to fill in low spots and level the land, all these costs are included as part of the cost of the land. And these are some examples with some numbers. And let's say you purchased the land for $500,000 and there was an old building on the land. Now you did not really want to use the old building, but you wanted that land. So that cost you $500,000. Commissions you had to pay for, $30,000. Back taxes, title insurance, $3,000. Then you had to pay to have the existing building removed. So it's demolished and removed. That cost you $50,000. And then you sold some of the salvage materials from the old building, the existing building, for $5,000, and that reduces your cost of the land. This is money you got back from selling the old building parts and debris and so forth. Cost of the leveling the land, it goes in here, $6,000. And so in your land account, you'll have $590,000. So again, the amount in your land account includes the initial purchase price plus all expenditures, net of the salvage materials like the $5,000 we see up there earlier, necessary to get the land ready for its use. Now, land improvements are items that are different from the land that we just saw on the previous slide. Land improvements are items such as parking lots, sidewalks, driveways, landscaping, lighting systems, fences, and sprinklers. And these are not, let me repeat, these are not to be included as part of the cost of the land. They have their own separate account called land improvements, and these items will be depreciated. We're going to talk about depreciation in a few later slides, but one thing to remember is land, the land account itself, that cost is never depreciated, but land improvements, those are depreciated. Buildings, you can see what those are in the reading, and what we need to include here will be not only the cost of the building, but any real estate commissions we paid for purchasing the building, other fees, of course, any inspection cost, remodeling cost, anything incurred, any cost incurred in your purchase of the building will be part of the building cost itself. Recurring costs, such as utilities, insurance, and also repairs and maintenance, those are expensed. Those are not incurred Well, those are not included as part of the cost of the building itself. Equipment, it can be manufacturing equipment, computers, office supplies, and so forth. The cost of the equipment would include things such as sales tax that goes in the equipment account, shipping to get it to your place of business, cost incurred to assemble the item, and any other cost incurred to get the equipment ready for its intended use. All these items will be included as part of the cost of the equipment account. Again, recurring costs such as maintenance and repairs also are expensed as incurred. They are not capitalized, and capitalized means included in the asset account. So recurring costs are not capitalized as part of the equipment cost. Here's an example. If you purchase an item that costs $82,000, sales tax $6,500, you would add to this the transportation cost, shipping, insurance, and installation cost, and that would be the total cost of the equipment that would show up in the equipment asset account. Now, goodwill is an intangible asset, and goodwill is the price you pay for a company above the identifiable net assets that you have in the company. So you only record goodwill in a set of accounting records if you purchase another building. So it's the purchase price you paid above the fair market value of the identified net assets acquired. Net assets will be the assets acquired less liabilities. And goodwill, again, is the portion of the price that exceeds the fair value of those identifiable assets. Let's look at an example. One company buys another one for $36 million. You look and see the assets that can be identified, and these will be things such as inventory, buildings, land, equipment, and so forth. Also intangible assets such as copyrights, trademarks, and so forth. That totals $50,000. But it does have liabilities. So liabilities will be $24 million. So $50 million and $24 million. So now we have the purchase price, $36 million, less the fair value of the net identifiable assets. Here are the net assets. So the assets are worth 50, liabilities 24, net those out and get 26. We paid 36 million. The net identifiable assets have a value of 26. Therefore, goodwill is $10. Or in this case, $10 million. Now, repairs and maintenance. We will incur this, of course, on a regular basis on almost any asset that we have. Then we have other expenditures, additions, improvements, litigation costs. So, for all expenditures after acquisition, if they benefit only the current period, we need to expense those. So we will debit repairs and maintenance expense, whatever expense account that we're using. This is the expense that goes straight to the income statement this year. Or if we incur cost after acquisition, we might capitalize the cost. So if we incur a cost that benefits future periods as well as the current period, we will capitalize those. In other words, record those as an asset. And they'll be recorded as an asset in the account that relates to. So if we make a major improvement on a building, like add an addition to a building, that would be put in the building account. If we make a major expenditure for, let's say, a delivery truck, where we put in like a new engine, that's a major item. It'll benefit future periods, so we will include that as part of the equipment account. So here's a little slide you can review. I won't go through it right now, but come back to this slide later when you want to and look at all the definitions, the period benefited, and how we usually treat these items. Let's talk about depreciation. Now, the dictionary depreciation for depreciation, and this is the one we usually think about when we're out of the accounting, text of things. We think of it as the decrease in the value of an asset. So if we purchase a car, we think, well, it is depreciating. It's going down in value. That's true. That's a very commonly used definition for depreciation. But for accounting purposes, the accounting definition is the allocation of an asset's cost to expense over time. So let's dig into this and see what this really means. You buy an asset today, back here in the original time period, but it's going to last 1, 2, 3, 4 periods, 4 time periods, like 4 years. That means you need to take the original cost of the asset and spread it over each of the 4 years it'll be useful to us. So that is the accounting definition of depreciation. It's not necessarily the decline in value, even though yes, that might be going on, but it's the taking of the original cost of the asset and spread it over its useful life. To record depreciation, we will debit the depreciation expense account, in this case $300 for the example, and credit an account called accumulated depreciation. Depreciation expense is a regular expense account, shows up in the income statement. Accumulated depreciation is a contra asset account. A contra asset account. It shows up in the balance sheet right under the asset that it relates to, like building or equipment, and it is a negative number in the balance sheet. So it's a contra asset account, a negative number on the asset side of the balance sheet. Here's how you would show it. The original equipment cost, $1,200, and then this credit to accumulated depreciation comes in here and is a negative number in the asset section, so it reduces the equipment down to a book value of $900. So book value, the definition for book value for accounting purposes is the original cost of the asset less the accumulated depreciation taken to date. So the original cost less accumulated depreciation, that is book value for accounting purposes. Let's cover some depreciation methods. And this is going to get a little detailed if it hasn't already. So we're going to see quite a few numbers in these next several slides. So please come back and review this if you need to. Let's start off with the cost of the new truck, $48,000. Estimated residual or salvage value, $5,000. And that's the value you expect the truck to be worth at the end of its useful life. And if you have an estimated service life to you, in other words, you think you're going to use it for 5 years, that's the number you're going to deal with when we compute depreciation. And we think that at the end of this 5-year period, the truck will be worth $5,000. For straight line depreciation, here's the formula. We'll take the asset's cost in the numerator, subtract the salvage value, and divide by the service life in years. Plug in the numbers in, the $40,000 minus the 5 goes in the numerator, divide by 5 years, estimated useful life, and so $7,000 per year is how much we will take as depreciation expense for this asset. Here's a little depreciation schedule to keep up with how much we are taking on the asset each year. The original book value, you can see, original cost, $40,000. At the end of the first year, we will take $7,000 depreciation expense, and $35,000 is what they call depreciable cost. Remember, this is in the numerator we just saw, $40,000 minus the $5,000. The 20% is 1 over 5. Remember, 5 years estimated life, divide that into 1 and 20%, and then that gives us $7,000 depreciation expense. At the end of the first year, the accumulated depreciation will be $7,000, and the book value drops. So book value is always original cost minus accumulated depreciation. So 40 minus 7 gives us $33,000. Year number 2, and on through 3, 4, and 5, same depreciation per year. That's why they call it straight line. Same each year. Total of $35,000 in depreciation over the entire 5-year period. In this second year, we're taking the year before's $7,000 in accumulated depreciation, adding this year's depreciation expense, and getting $14,000 as the new total in accumulated depreciation. Take 14 from the original 40, and we have $26,000 book value. In year 3, same thing, $14,000 the year before accumulated depreciation, add 7 to get 21. 40 minus 21 gives us 19. So do that for each year, at the end of the 5th year, we have fully depreciated the asset, at least as up to its depreciable value. That is the amount in accumulated depreciation. And then we have $5,000 in the, well, that's the book value at the end of the year. That's the residual value equals the book value at the end of its useful life. It should always work out that way. If we purchase the asset sometime during the year, we'll need to take a part year depreciation expense on that asset. So if we purchase the asset on March 1st instead of, let's say, January 2nd or 3rd, then we need to divide up the $7,000 because we haven't held the asset the full year. Here's what we'll do. In year 1, a full year's depreciation, remember, was $7,000. We've held the asset for 10 months out of the 12 months. March 1st, we did not have the asset January, February, so we did have it the rest of the year. So 10 months over 12, $5,833 is the depreciation expense for the first year. Years 2 through 5, still $7,000 per year. But then we have a little bit of depreciation that spills over into year 6, 2 months over 12 times the 7. So $1,167 is depreciation expense in the 6th year, and so we still take a total of $35,000 depreciation expense. Now it's spread over 6 years because a partial year the first year, partial year the 6th year, but still a total of only $35,000 depreciation expense on this asset. Now here's a new method. This is a little bit different. It's called the double declining balance depreciation method. What we will do the first year is take the full $40,000. Don't pull away salvage value. We don't in this method. This says double the straight line rate. This is 2 divided by 5. So always put 2 in the numerator, and if the estimated life is 5 years, put that in the denominator, divide 0.4. If you had 4 years, it'd be 2 over 4, 0.5, and so forth. The expense then this year is $40,000 times 0.4, $16,000. So that's more than double the first year's depreciation for the straight line method. So it's called an accelerated depreciation method. We take more depreciation the first several years as compared to the last several years. Accumulated depreciation at the end of the first year, $16,000. Book value, 40 minus 16, 24,000. Now the second year over here, we take the end of the previous year's book value, this 24, drop it over here, times the same 0.4. Here we get only 9,600. So that's the declining balance part of this. The book value declines, the expense declines each year. Still the same 0.4, don't change this. But now it's only 24,000 times 0.4, 9,600. Take the 96, add to last year's accumulated depreciation to get 25,600. And the book value now is 40, minus 25,600 to get 14,400. Year 3, same thing. 14,400 drops in here, times 0.4. Here's the expense, increase accumulated depreciation, and you keep going. Get to the last year, and what we do the last year is don't use the same formula. Take last year's book value, year 4's book value, drop it in here for year 5. Don't multiply. We just use a number we need to get the total depreciation taken to $35,000. Remember, we still use the salvage value to keep up with book value. We don't want the book value to drop below salvage value. We did not use salvage value at the beginning of the depreciation calculations here. We ignore it. But we do in the background keep up with it. And so it's last year's what we just call a plug figure. Whatever we need to get the $5,184 down to the residual value of $5,000. That's $184. Again, it's just a plug figure. We don't use the regular computation. So in this method, you can see we have a lot of depreciation the first couple of years, but very little the last couple of years. But overall, the same total depreciation. The third method is the activity-based. Here we have the same beginning numbers, the cost of $40,000, the estimated residual value $5,000, service life 5 years or 100,000 miles. Here we don't depreciate the amount based on time, we depreciate it based on usage. So let's get a depreciation rate per unit. In this case it'll be per miles. So we still have the 35,000 net in the numerator, and then we put the expected miles up here in the denominator. Divide, and so we're going to depreciate this item, this truck, at the rate of 35 cents per mile. The depreciation expense will be based on how many miles we drive each year. So in this case, in the first year, if we drive 30,000 miles, we take the 30,000 miles times 35 cents to get 10.5 depreciation expense. Accumulate depreciation, book value then drops. The second year, these are miles. These are not book value. These are miles over here. So second year, 22,000 times the same rate of 35, 7,700. Third year, only drive at 15,000, only 5,250 expense. We go back up in usage a little bit in year 4, 20,000 times 0.35 and $7,000. Again, never take more total depreciation than that depreciable cost that we have at the very beginning. And the depreciable cost is the original cost minus residual value. You'll minus that salvage value. Comparing the three methods. This is what I just said. It doesn't matter which method you use, straight line, double declining balance, or the activity-based, the total depreciation is the same. It depends on whether you want the same depreciation each year, straight line, or have more depreciation earlier than later, double declining balance, or it can be sort of a combination. You can have more depreciation 1 year, less, then back more again. This is based on activity. But again, you never have more depreciation under any of these methods compared to the others. Here's a chart showing straight line, same per year. Declining balance, starts high, get low. Activity-based, might start a little bit high, might drop, might go back up, and so forth. Depends on your actual usage. Now, straight line is used by most companies for financial accounting reporting purposes. It just so happens also that most companies would also use declining balance for tax purposes, but for financial accounting they would use straight line depreciation. And to complete the discussion on depreciation, let me go back up a slide. The reason a company would use declining balance is to save income taxes in the earliest years. So most companies, for their tax returns, will use double declining balance. That gives you higher tax deductions the earlier years, saves you taxes. Now, yes, the deduction does turn around and is lower in later years, and you will pay more taxes in later years. But when you take into consideration the time value of money, a dollar today is worth more than a dollar in the future, then you'll want to save taxes today, and then pay a little bit more taxes with lesser value dollars in the future. Disposing of an asset means you're going to either sell it, retire it, which means sometimes you just take it to the dump and just throw it away, or you might exchange it. Let's look at just the first two. We're not going to worry about exchanging an item for this course. This is the most common. You sell an item. Sometimes you just throw it away. You cannot sell it and exchange it. You want a new one. Original numbers again: 40,000 cost, residual value 5, and service life also 5 years. And use straight line depreciation. Let's look at the situation if you sell the truck after 3 years for $22,000 or after 3 years for $17,000. And then what happens if we just retire it? We're going to ignore this last one, so don't worry about it. If you sell the truck for $22,000, that's the cash we are receiving, The original truck cost, the truck original cost is $40,000. And remember, $7,000 per year straight line depreciation. 3 years, $21,000 has been taken. The book value at the end of 3 years is $19,000. The original 40 minus accumulated depreciation of 21. Our gain is $3,000. So if we sell the item for more than book value, we have a gain. 22 minus 19, $3,000. The accounting entry, cash comes in the door 22, that's the debit. We remove the accumulated depreciation account by debiting it $21,000. We credit equipment, $40,000 original cost, and we record the gain, and gains are always recorded as a credit for $3,000. Now these two items, like the green print says, these are reducing these two accounts to zero. We're selling the asset, take off the accumulated depreciation, take off the equipment account. So this is the entry when you have a gain. Now let's sell the truck after 3 years for $17,000. $17,000 is the cash we received. That's the debit. Original cost is $40,000. Subtract accumulated depreciation. You still have the same book value of 19. These entries are still the same. Debit accumulated depreciation, $21,000 to bring that account to zero. Credit equipment, $40,000 to bring that account to zero. But now we sold the item at a loss. We sold it for less than book value. Losses are recorded as debits. So loss is debited, the entry balances. If you add these three debits up, they total $40,000. So we always record losses as debits, and the gains we have selling equipment or the losses will go straight to the income statement. If we decide just to retire, in other words, just throw the item away, just give it away or throw it away, we get no cash for it. We still have a book value of 19. That means the loss is 19. Remove the accumulated depreciation, remove the equipment, and the entire book value is the loss. We did not receive a penny for it. So if you remember, in all three entries, selling at a gain, selling at a loss, or just giving away, like in this case, the debit to accumulated depreciation, $21,000, and the equipment credit of $40 were the same. Those were always the same, no matter what we sold it for, or if we had a loss or a gain. Here are some ratios. Return on assets. This is net income divided by average total assets. You're trying to see what kind of return you had on your investment in your assets. This is a very common ratio to compute for companies. What kind of return are we generating on the assets we have invested in the company? So average total assets in the denominator will be the beginning of the year total assets plus end of the year total assets divided by 2. You can expand that formula a little bit, and it breaks out into two parts. There's the profit margin, which is net income divided by net sales. How much earnings you have per dollar of sales is what that shows. Asset turnover measures the sales per dollar of assets. How well are you generating sales based on the average assets you have invested in the company? So we have three new ratios really in this chapter. Asset turnover, not a very popular ratio. Profit margin, yes, that's very common. And those can be multiplied by each other to arrive at this original one, or you can compute it just net income divided by average total assets. So again, a couple of ratios to sort of see how well you're doing in using your assets to generate net income or to generate net sales. Well, that's the end of Chapter 7. It's a very detailed chapter, a lot of numbers. So go back and review this set of slides if you need to, this video, and make sure, as always, read the chapter very, very close. Read it, several times, and follow all the examples through in the chapter. So good luck with your studies.